Futures trading is one of the most misunderstood activity in retail finance. Most people jump in without really understanding what they're doing. They see a chart moving up and down, they hear there's money to be made, but if you ask them what a futures contract actually is, why it exists, who they're trading against, or what really moves the price, most people cannot give you a clear answer. So what happens? They're participating in a market they do not fully understand. This video is the kind of introduction I wish I had when I started. Clear, honest, and grounded in how the market actually works. We're going to walk through what futures trading is, how it functions, who is involved, and what you need to understand before you start. By the end of this, you will see the futures market with a level of clarity that most retail traders never reach, even after years of trading. So let's get into it. Before we get into it, quick introduction. My name is Bobby C. Wang, founder and lead instructor at Lumeric Trading with focus on structured futures education for independent traders just like you and me. No hype nor shortcuts, just a clear framework for understanding how this market actually works. If you're new here, the first video breaks down exactly what we're here to build and how we wanted to approach it the right way. You will also find links to the free course, the comprehensive trading program, and the official course book in the description below. A futures contract is a legally binding agreement to buy or sell a specific asset at a specific price on a specific date in the future. That is the textbook definition. Well, now let's make it real. Imagine you're running an airline. Your biggest expense is probably fuel, and fuel price moves every single day. They're tied to crude oil, which reacts to things like geopolitical tensions, supply disruption, and changes in global production. With those factors shift, price can move very quickly. If fuel prices suddenly spike, like in March 2026, your cost of doing business can jump significantly overnight. Margins shrink and your business takes a hit. So what could you do to protect yourself? The answer is you could lock in your price ahead of time. You make an arrangement today to buy fuel at a set price 3 months from now. No matter what happens to the market in the meantime, your cost is fixed. That agreement is a futures contract, and its purpose is simple: reduce uncertainty or market risk. This is why futures market exists in the first place. It exists for businesses like airline, farmers, manufacturers, energy companies, and many more. All of them use futures to stabilize cost and protect against unpredictable price swings. Now, here's where it becomes relevant for traders. For every business that wants to lock in a price, there has to be someone willing to take the same order on the other side of the deal. That is where speculators come in. Speculators are not hedging risk. They are taking on risk, aiming to profit from price movement, and by doing that, they keep the liquidity that keeps the entire market functioning. We'll break down all the different participants in a later video. For now, just understand this: futures markets are not random. They exist for a clear economic reasons, helping businesses manage price risk, and everything we do as traders must sit on top of that foundation. Let's walk through how this actually works. Every futures contract is built around 4 key components: the underlying asset, the contract size, the expiration date, and the price. First, the underlying asset. This is simply what you are trading. It could be indices like the S&P 500 or the Nasdaq 100. It could be commodities like crude oil, gold, or natural gas. It could be currencies, interest rate, even cryptocurrency. Futures markets cover all of these. Next is the contract size. This tells you how much of that asset one contract represents. For example, one ES contract, the standard S&P 500 futures contract, represents 50 times the index. So if the S&P is trading at 7,000 points, one contract gives you exposure to $350,000. One NQ contract tied to the Nasdaq 100 representing 20 times the index value. This is where things start to get serious and interesting, because when you trade futures, you're not paying the full amount upfront. Instead, you post what is called margin. Think of it as a performance bond, a deposit that shows you can cover potential losses. For an ES contract, that margin might be somewhere around $12,000 to $15,000. Well, you're theoretically still controlling $350,000 worth of exposure. That gap is leverage. Leverage cuts both ways. A relatively small move in the market can translate into a meaningful gain or a meaningful loss on your account. This is not something to fear, but it is something that you need to understand with precision and respect. We will break down leverage and position sizing in a separate video. For now, just recognize how powerful it is and how important it is to manage it correctly. The third component is the expiration date. Every futures contract eventually expires. For most day traders, this does not impact daily execution because positions are typically open and closed within the same session. Hence the term day trading. But it still matters. Futures contracts roll on a schedule, usually quarterly. If you're not paying attention, you can end up trading a contract that is losing liquidity as the market transitions to the next one. Understanding where you are in that cycle keeps you aligned and where the volume actually is. And that is the core structure of a futures contract. Simple on the surface, but powerful once you understand how each piece fits together. Here's a practical example. Say the NQ, which tracks the NASDAQ 100, is trading at 25,000. One full NQ contract represents 20 times that value. That is $500,000 of market exposure, but you're not putting up $500,000 to trade it. The margin requirement might be closer to $20,000. Now watch how the numbers move on the NQ. Each point is worth $20 per contract, and if the market moves up 100 points, that is $2,000 gain. If it moves 100 points against you, that is $2,000 loss. Same move, same magnitude, just in the opposite direction. This is the leverage in action. You're controlling a large position with a relatively small amount of capital, which means even normal market movements can have a real impact on your account. And this is exactly why position sizing matters so much. Now, there is a more accessible way to approach this, especially for new traders. There are micro contracts. For the NASDAQ, that is the Micro NASDAQ 100 or MNQ. It is 1/10 the size of the full NQ contract. So instead of $20 per point, you're looking at $2 per point. Same market, same price movement, same decision-making process, but the financial impact is scaled down. This is where most beginners should start. You get to learn how the market behaves, how to execute trades, and how to manage risk without putting yourself in a position where a single mistake costs you thousands. You're building skill under a controlled environment, and that is how you last long enough to actually get good at something. One of the biggest structural advantages of futures trading over stock is simple. You can profit in both directions just as easily. If you buy a futures contract, you're going long. You make money if price moves up. That part is no different from stocks. But if you sell a futures contract, you're going short. You make money if price goes down. And in futures, this is just as easy and straightforward as going long. There are no extra steps, no borrowing shares, no special restrictions. You can sell first, then buy back later. That is a real edge. Markets do not just go up, they move in both directions. If you can only profit in rising market, you're missing a large portion of opportunity. Futures traders can participate on both sides. The second advantage is trading hours. Equity index futures trade nearly 24 hours a day, from Sunday evening through Friday afternoon Eastern Time. That means you're not limited to the standard stock market window of merely 5.5 hours. If you're trading from places like Dubai, Singapore, or anywhere outside of the US, this matters. You're not forced into a narrow time window. You can choose sessions that fits your schedule and still engage actively. More flexibility and more opportunity. If you know how to use it properly, that's an advantage to you. This is where most online content either overcomplicate things or worse, make it sound too easy than it really is. If you want to trade futures, there are 4 things you need. First, a broker account with futures assets. Platforms like Interactive Broker, NinjaTrader, and Tradeovate are commonly used by retail traders in the future space. Each one has its own fee structure, platforms, and margin requirements. There's no one-size-fits-all choice. What matters is that you fully understand the cost before you start. Second, a platform. Many traders use tools built in with their broker's account. At a minimum, you need to clearly see price action and volume. As you improve, you can layer in with more advanced tools. But in the beginning, clarity beats complexity. Third, capital. How much you need depends on what you're trading and how you manage risk. Yes, with micro contracts, you can technically start with a few $1,000s, but starting with the bare minimum is usually not recommended. You need enough room for proper position sizing. You never want to be in a situation where one bad day forces you out of the market because you cannot meet margin requirements. And fourth, competence. This is the part most people rush past or approach it in the wrong order. They start trading before they understand what they are trading, and that is where real problem begins. This video is your starting point. The content on this channel is designed to build that knowledge step by step. And if you want to go deeper, the Lumeric Trading program expands on the framework in details. I also break down realistic capital requirements with actual numbers in Day Trading Futures, a practitioner's guide for independent traders. Chapter 1, Section 4, the answer is more nuanced than most people expect. The book is available on Amazon, link in the description below. We're about halfway through. If this starts to click for you, go ahead and like the video and subscribe. It helps this reach other traders who are serious about learning just like you. And drop the word trading in the comments below. We'll send you our free guide, 7 reasons why independent traders fail. It is built on the same framework we use at Lumeric and is completely free. Here's something that will completely change how you see price action once it clicks. Most of the time when you place a trade, you're not trading against other retail traders. You're trading in a market dominated by institutions, firms with more capital, better technology, and faster information than most independent trader will ever have. So the question is not, how do I beat them? The real question is, how do I understand what they are doing well enough to avoid being on the wrong side of it? Let's simplify who is actually in this market. First, you have hedgers. These are the airlines, manufacturers, and agriculture businesses we talked about earlier. They are not here to speculate. They're here to reduce uncertainty in its core operation. Their goal is stability, not profit from trading itself. Second, you have institutional traders. These are large funds, hedge funds, pension funds, sovereign wealth funds. They take directional positions, often over longer period horizon. But here's the key. They cannot just enter a massive order all at once. For example, a $40 million order will move the market against them. So what do? They break it up. They execute over time, and that activity leaves a footprint in the market if you know how to recognize it. Third, you have market makers. Their role is not to predict direction. Their role is to provide liquidity. Think of them like a merchant at a marketplace. If someone wants to buy, they sell. If someone wants to sell, they buy. They earn the spread between those two prices. They keep the market moving. Understanding this is critical because not every trade you see is someone making a directional bet. And finally, you have speculators. That is where we sit. Independent traders, day traders, swing traders. We're the smallest players in terms of capital. We do not win by having more resources. We win by being more precise. Better timing, better risk control, and a better read of the structure we're operating in. Here's the reality. In short term, futures trading is a zero-sum game, not including commissions and fees. When someone makes money, someone else is losing it. So the more you understand who is participating and what they are trying to accomplish, the better decisions you will make. That understanding is not optional. It is one of the real edges an independent trader can develop. We will go much deeper into this in upcoming videos. Let's close this section with a direct look at the mistakes that take most beginners out before they ever get a real chance to improve. First, trading too big. Futures leverage is powerful, and early on, most people underestimate it. One full MQ contract can swing $2,000 in minutes. If you're trading a $10,000 account, that is a 20% move on one side. That is not sustainable even if you're right. Start with micros. Respect position size. This is not a detail, it is foundational. Second, trading without a plan. Not an idea, a real plan. Written out, clear entry criteria, defined stops, target levels, and hard limits on how much you're willing to lose in a day or a week. Discipline is not something you feel. It is something you build into a system. Without a plan, every decision becomes reactive, and reactive decisions under pressure rarely goes well. Third, ignoring the psychological side. Futures trading put profit and loss right in front of you in real time. Wins can make you confident, losers can trigger fear, frustration, and urge to make things back quickly. That is not a personal weakness, it is just how humans respond. The difference is whether you have a way to manage it or not. Lastly, chasing strategy instead of structure. Most trading education content focuses on entries, patterns, indicators, and setup, but strategy sits at the end of the process, not the beginning. Before that, you need market understanding, a solid risk framework, and control over your decision making. Without those, even a strong strategy will break down in real conditions. Structure comes first, strategy comes later. Let's bring this together. First, a futures contract is a binding agreement to buy or sell an asset at a set price on a futures date. It was built for hedging. As a trader, we use it for speculation, but understanding that difference is critical. Second, futures involves leverage. One contract controls a large amount of exposure for a relatively small margin deposit. That cuts both ways. Gains and losses are amplified. If you're learning, start with micro contracts and respect position size. Third, you can go long or short with equal ease. You're not limited to rising markets. That gives you access to opportunity in both directions. Fourth, this market is not made out of traders just only like you. It is driven by institutions, market makers, and hedgers, all with very different objectives. The better you understand their behavior, the better you understand price movement. Fifth and lastly, strategy comes after, not first. Before that, you need market knowledge, a solid risk framework, a written game plan, and the discipline to follow it under pressure. That is the foundation. Everything else we cover here builds on top of that. If this gave you a clear sense of what this channel is about, go ahead and like the video and subscribe. We post post structured futures education every week, and each video builds on the last. If you're going to follow this, follow in sequence. Comment trading below and we'll send you the 7 reasons why independent traders fail guide. It is free and is tied directly back to the 4 pillars we covered today. If you're ready to go beyond YouTube, the Lumeric Trading program walks through the full framework in depth. Market dynamics, trade analysis, risk management, and trading psychology. All structured and taught step by step. You'll find the link in the description. And for those who want more of a personal touch and direct guidance, I offer limited one-to-one coaching sessions where we take a focused, in-depth look at your trading, your process, your decision, and where things need to improve. You can book that directly through the website or in the link below. Our official course book, Day Trading Futures, A Practitioner's Guide for Independent Traders, is also available on Amazon. It is the written version of everything we teach here. Even the preface alone will give you the right perspective before you go further. If you'd like to learn more about futures trading, click this video. You're one video closer to being a professional futures trader. Thanks for watching, and we'll see you in the next one.